And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It's a new year. ETFs keep growing, but what will be hot in 2020? Nick Colas, he's the co-founder of DataTrek Research. Tom Lydon is CEO of ETF Trends. They join me now. Tom, fire up that crystal ball of yours. I want your thoughts on what happens this year. 3 trends. The long-awaited Bitcoin ETF, cannabis, ESG. Let's start with Bitcoin. Any chances? Any chances? Now, how many years are we doing this?
I know.
Rerun the last 2 years. Any chances for a Bitcoin ETF?
It's Groundhog Day, right, Bob?
Yeah.
Well, I'll tell you, there are a couple good things that have happened. First of all, the SEC approved the first 40 Act approved ETF. Again, there are a lot of limitations, but just a couple weeks ago. And today...
What does that mean, a 40 Act? I know it's a mutual fund act, but what does that explain to the viewers what that means?
So what it is basically approve that it's filed as publicly traded. So you can, like a regular mutual fund, like the Magellan Fund, there's a sister mutual fund out there where you can invest in Bitcoin. However, it's limited to only $25 million at this point.
So are we going to get a real traditional ETF as we understand it?
I think we will. Today, the CME is offering Bitcoin options for the first time, just granted today, which is fantastic. SEC is concerned about liquidity, so they're going to bypass that through options and futures, and then also safety. The more we can get on publicly account statements like your Schwab account, like your TD account, that's going to help things out.
Handicap it. Chances of a Bitcoin ETF this year?
60% this year.
60. Nick, chances?
10.
10. I'm with Nick. They still haven't figured out. Remember, it's not. You're not dealing with the CFTC here. This is not futures.
All right.
Different people. SEC is terrified. Grandma is going to buy Bitcoin ETF. It's going to collapse. And 5 years later, all the people running the SEC are going to get hauled in front of Congress and say, are you the guys who approved Grandma buying the Bitcoin ETF? It's not the CFTC.
But if it's on registered brokerage statements, so much better because they can see what's going on. All right, we're going to bet a cheeseburger on that.
Very good. I'm in on that. Like crypto, the cannabis industry isn't going away anytime soon. Cannabis ETFs and cannabis stocks, half off where they were a year ago. Maybe they should be half off. More states are legalizing marijuana. The Fed is allowing proper banking, or maybe will we see more assets into cannabis ETFs?
It's not going away. We know that. And as more states, as you say, allow cannabis in their states, great. And also the Fed banking is key and critical.
You've written about this before.
Yep. Bottom line is, if you think there's a chance of an Elizabeth Warren or Bernie Sanders presidency, you got to buy that group today, because that's the scenario.
You think it's a political play, largely?
It's a 100% political play.
Okay. Yeah. ESG, environmental, social, and governance ETFs, the breakout product in 2020, finally attracting some real money. Will sustainable investing eventually become the norm for global investors rather than just a choice? And there you see what is involved in ESG. You've written about this as well, Nick. Is this a real sustainable investment at this point?
It absolutely is. The rip in assets last year was as much about bringing some products to market that were cheaper than the ones before, so that really helped. But I think everything is going to be ESG going forward. It's such a big topic.
If you can buy the S&P 500 in the ESG form, which you can for 7 basis points today, why wouldn't you do that, especially with the idea that you aren't going to give up performance?
I like ESG. It's still a bit murky. The SEC has said that. They put out a notice saying, guys, tell us a little bit more what these categories are and how you define what they are. That's a problem, but it's a heck of a lot better than it was even 4 or 5 years ago.
True.
I'm in favor of it. Ethically, of course, I'm in favor of it, but I'm in favor of it because they're going to start tightening up the criteria, and I think that's a good thing. Markets are at new highs, but the new money for 2020, it's not evenly distributed. It never is. Where is the money going in 2020 so far? Nick, a few trends stand out to me here. Outflows from gold funds, inflows into growth and emerging markets. Gold in particular, seen outflows over 500 million in the last few weeks. Nick, what's going on?
Yeah, that's just at the beginning of the year. And I think it's been caused by the gold's rip in the very back half of last year and some rebalancing of portfolios as we start 2020. I don't think it's anything fundamentally bad. As a matter of fact, central banks are still buying a lot of gold. It looks pretty good for 2020 as well.
And the demand in emerging markets, especially as more citizens are entering middle class, they have more money. What are they doing? They're buying gold.
Yeah, makes sense to me. Growth ETFs. We had this debate. Had big inflows this year. Value funds have seen outflows. This is a big difference from 2019. The flows were into value. They were 3 times bigger than into growth, particularly in the fourth quarter, Nick. One trend, continuing? Flipping around here, that growth and value, is that going to continue?
I think it will. The growth ETFs that most people own are predominantly tech, 30 to 40 to 45% technology. That group should continue to work. The value ETFs are all financials, or heavily financials. That's still going to lag. So I do think we're going to see a reversal in 2020.
Yeah, value still is financial. Some energy stocks.
It is, and growth is so FANG heavy. It's crazy, even with these diversified indexes and advisors. And we're watching their movement on what they're looking for, what type of ETFs that they're looking for, and a lot are looking to diversify. They want to get out ahead of this late-stage bull market.
We've been talking about this for years. I think the problem is growth is getting harder to find, so people will pay more and more for that, and you don't get GARP anymore. You get growth at a reasonable price, you get growth at any price. You get GAAP, growth at any price, essentially, and I think that is a problem. At some point, people push back, but it's not yet. It hasn't happened yet.
No, and what happens, most people always do it after the fact.
Okay, one trend is continuing from 2019. Emerging market flows are off to a strong start, attracting $1.5 billion in 2020, more than double the run rate last year. That is a trend. Now we got a somewhat weaker dollar. We got a better, a somewhat belief in a bottoming in the global economy. Is that going to continue?
Absolutely. It's a pretty bullish sign to see money flows into emerging markets. They tend to be the ones that will work in a late stage part of the cycle when all the developed economies are chugging ahead and EM kind of comes along with it. And it's a very important point of validation that we are going to get a US-China trade deal this week.
Going to make it?
Valuation standpoint, you're 40% off US stocks. EM stocks are a deal at this point.
Yeah, I would agree with that. Finally, as we enter a new decade of investments, it's wise to review some sound investing principles around ETFs and any other investment vehicle. Here to help us out, Dan Egan. He's Managing Director of Behavioral Finance and Investing at Betterment. He has spent his career using behavioral finance to help people make better financial and investment decisions, including around investing in ETFs. And Dan, it's good to have you. We're all behavioral economists now. I like to say.
Everybody's a psychologist.
Yeah, right. After the financial crisis, we're all behavioral economists. But you have some very good points about investing in ETFs that people have made in the past, including, and we love talking about thematic ETFs here. Mm-hmm. We love talking about pot. We love talking about ESG. Bitcoin. We love talking about Bitcoin.
Yep.
But these are bandwagon things. People get excited about them, and then they blow up. This happened with Bitcoin. It happened with cannabis. It has not happened with ESG yet, but it's still, give it some time.
Yep.
What should people know about investing in faddish, thematic, whatever you want to call it?
You know, one of the best signals is if your brother-in-law is talking to you about it over Thanksgiving, you might want to watch out for it. Over the past, I'd say sort of like, you guys would know this better than me, but say 5 to 10 years, speed has gotten quicker. The ability to go to market with a new ETF based upon a theme has dropped. The asset base that you need in order to launch that fund has gone down too. So we're seeing quicker uptake on whatever the latest fad is. And I think that might have been Hack or Robo or a lot of the cannabis ETFs. So if we're looking at actually how quickly did the underlying asset price come up, how much are people talking about it on social media, think about any other kind of like viral or contagion thing. How fast is this going to spread? Then you had an ETF issuer jumping on the bandwagon and saying, hey, I could probably clip a little bit of a premium. How much could I charge 40, 50, 60 basis points for a fund that rolled this up and made it easy for somebody to trade? Mm-hmm. Now, I think that ESG's been around a lot. We have a lot more infrastructure assessing whether or not something is an ESG or not fund. And so I think that's a little bit of a longer play. I think people have wanted that, and it's more aligned with values than about whether or not ESG has done well recently. Yeah. So the first one is, has it performed well recently? If no, and it's still growing, that's interesting. If yes, then it's more likely to be speculative.
But the pricing, what is interesting is how similar human beings are. They drive up stuff to stupid levels. So we saw the pricing for pot ETFs go through the roof. We saw it for Bitcoin go through the roof. So, I mean, there's a reason we keep talking about tulip mania and all that. It's because we keep repeating things over and over again, the same behaviors.
And it happens faster now. This is what the internet does, right? They blow up faster and they fall faster. So the turnaround time on Bitcoin was amazing. The turnaround time on the pot ETFs was amazing. Everything's gotten faster such that we see the cycles quicker because of the internet.
Yeah. Now, another point go ahead, Tom.
Yeah, Dan, so what I was going to say is the S&P 500 is not the S&P 500 that it was 10 years ago.
No.
We've got 18% in some FANG stocks, high technology based stocks. And we know when there's a correction in place, they're probably going to give back more than others. We don't have a lot of innovative technology companies, all the different technologies as far as mobility and technology and phones and that type of thing. you have to look to the future for these new companies that are up and coming, and most of our big major indexes don't have those types of allocations. What do you do at Betterment to make sure that your investors participate in that?
I think that's actually a bigger issue almost along the regulatory lines, right? Like when and how do companies get to IPO? What sort of level of knowledge or money should accredited investors have to bring to the table in order to be able to invest in these things? The dynamics of the IPO market over the past 20 years has definitely shown that companies are staying private longer. They're more worried about when they go public, how do they go public in a popular way. I'm not a private market regulator, so I can't speak to that, but I definitely think that we need to watch out for allowing people to speculate in less liquid, less transparent companies.
Yeah. Another point that you make, you don't need 50 ETFs. This is a great point. People always ask me, what do we recommend? And we've put up many, you and I have done model ETFs portfolios on the back of an envelope, you know, 7, 8, 9 ETFs. You can have a fairly diversified, even global portfolio that's out there, and yet people, maybe this is the fault of the media. We keep throwing out 50 ETFs. People keep asking about 50 ETFs. So maybe we're partly culpable. But how do you explain that to people?
One of the things I like about New Year's is it gives you that fresh start where you can say, maybe it's time for me to do a little bit of house cleaning. And you know, I've done this. You accumulate holdings over the years. Here was this thing that was like the best choice maybe 10 years ago. And we're going to talk about this in a little bit about how the big names over time sometimes aren't the best bet for you. So you accumulate things, and you got to have some point in time where you take stock of what your holdings are and say, is this actually still a good fund for me to be holding moving forward? One very common bias, especially in taxable accounts, is that people don't want to realize the taxable gains and pay the tax. And in a weird way, they'll end up paying more over the life of a fund if it's charging an extra 20, 30, or 40 bips than if they just sold out of it and went to something cheaper. So
isn't the simple way to explain this is, okay, you want a globally diversified portfolio and give me 50 ETFs. Now I'm going to give you 7 or 8 and I'm going to back test it and show you just owning those 7 or 8, you get the same return essentially as owning the 50, right? Nick,
that's right.
You're a data guy.
No, as long as you've got a diversified portfolio, 5 to 10 names will do it all day long.
There's the bottom line. Okay, let's move on. I think we hit that one pretty well. Biggest are not necessarily the best. I mean, we make a big point about the top 4 or 5 ETFs out there. SPY is a good example.
Great example.
Huge ETF out there, but it's not necessarily the right one for everybody.
No, you can get the exact same exposure as SPY for 1/3 of the cost with VOO. One of the things that happens over time is we talk about SPY nonstop. There's a lot of big names, EFA, EEM, that are funds that have been around. They're very liquid, they're very large. They're usually used by large institutional investors because of that liquidity. They can count on it in order to trade it, but that doesn't mean it's necessarily good for a long-term buy and hold investor.
So SPY is 9 basis points now, I believe, and IVV, which is the S&P, Vanguard's S&P, is 3 basis points.
3 or 4, and VOO
is it 3 or 4, Tom?
Yeah, it's 3. But the bottom line is our portfolios aren't going to be made or broken by 6 basis points. I think the big thing is we don't have a lot of time left. What do we do for the generation that's coming up? I mean, what are some of the key things that you can do to help our kids out so they can participate because they've got the time that we don't?
We don't have a lot of time left? I didn't get the memo on this. Like, I was in a good mood, now you just threw me off. All right, assume that he's right. He's wrong, but assume he's right.
You got to throw him in there. You got to throw him in there with a little bit of guardrail on. You got to give him the money. You got to let him make the mistakes. Like, I think about this as the school of hard knocks. There's the school of hard stocks. The best way to learn is to actually take your hits, learn these things, and you got to learn that you're not the best investor ever, and the best thing for you to do is dedicate your time somewhere else. So give them money, let them invest, let them learn their own way.
Careful when you trade. Now, this is an interesting point. This is a technical aspect of the market, but we brought this up before about be careful when you trade in the first half hour and the last half hour. Why should people be careful?
There's much, much wider spreads in the first half hour and the last half hour. I don't want to get into too technical details. You guys probably know it better than I do. But that's when the auctions are happening to open and close the market. What is the clearing price? And there's a lot more noise and uncertainty then, especially if you're trading in overseas assets.
It's difficult, though. A lot of people, they just put in market orders for the end of the day. I mean, we see them all the time.
You guys know, set limit orders if you're trading ETFs.
Yeah, that's right. And bottom line, don't trade the first half hour of the day.
Yeah. Well, let me just move on. Why do people spend so little time thinking about their retirement? I'm going into my 30th year at CNBC. This is the most astonishing thing to me. People obsess about the Super Bowl, hours and hours, and yet they spend more time figuring out, what kind of Super Bowl team they want to bet on, what kind of toaster they want, then what kind of retirement they want. What is it about humans? Is it too complicated? People can't think ahead? What is it that makes us so reluctant to think about the future?
You put together like the three things that people dislike most, right? Things that take a long time to give you any feedback about whether or not you're doing well, an inability to really compare to your peers to understand what's going on with everybody else, and math and reducing how much you spend. That's like a perfect recipe for people not wanting to do that thing. And especially like when people are young and they have a lot of time, there's other goals they want to knock over quicker. Like I want to get married, I want to buy my first house, I want to feel like I'm sort of wealthy compared to my peers. So all of these things set us up to say, well, I'm going to start saving for retirement once I hit 45 or 50, when I have the spare cash and when this is really looming. And unfortunately, that's when you have less time to grow.
And so the way out is show them, I always do the power of compounding interest. This year I made a point, and my nieces and nephews are in their mid-20s, I opened Roth IRAs for all of them. I gave them $1,000 and say, here's, and let me show you what 5% invested in $1,000, put $1,000 every year for 30 years at 6% compounded return, and the numbers get parabolic as you get older, and that's the beauty of compounding interest. Isn't it as simple? They got that. They said, oh, wow, so I'll have that much.
Isn't it true that Warren Buffett made sort of something like 50 or 95% of his wealth after the age of 50? Like compounding worked for him.
Yeah, it did. You give automated reassurance when people are doing the right things, when they line up their goals the right way. How important is that to investors?
Tremendously, right? Like, at the end of the day, we've got like a 40-year time horizon that we're working for here. What you need to know is I am doing the right things today. I'm taking the right steps, doing the right actions in order to put myself on a good path. So giving them that little intermediate feedback, right? Like, I am not going to come in and be able to bench press 250 pounds today, but if I come in and I do my reps, I'll get there eventually.
Great discussion, guys. Really enjoyed it. Love talking about behavioral economics. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Tom and Nick and Dan for joining us today, and thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. No show next Monday as the markets are closed for Martin Luther King Day, but we'll see you next Wednesday instead. Same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.